He promised us the keys to the kingdom, the secret handshake, the whispers of the smart money.
Yeah, baby!
For 5 long years, I immersed myself in it day in and day out, studying, practicing, believing, and I'm here to tell you, it's all a scam.
Keep giving me comedy.
For those who don't know, I'm talking about ICT,
I'm inner circle trading now.
the inner circle trader, whatever you call him. He's a figure who has cast a long shadow over the retail trading world for years. And for years, I was one of his most dedicated students. I watch every single YouTube video he has.
Hold on, folks. I'm back.
I watch all of his private mentorship videos. Don't get me even started with 4-hour-long Twitter spaces. Yes, I listened to those too. I poured countless hours into understanding his concept. The fair value gaps, the order blocks, the immediate rebalances. I studied the narratives, the market structure, the supposed secret sauce that was meant to unlock consistent profitability. And sometimes it even worked for a brief period of time. It would make me think I was on top of the world, that the Lambos and limitless vacations were right around the corner, that I had finally figured it out, just to fall flat on my face again and again and again. Here's the real mistake most retail traders make. They never properly test the strategy. Because it worked one time, they assume it works in all market conditions. That's not how professional trading works. If you want to know whether a strategy is real, you must test it across years of data. Bull markets, bear markets, high volatility, low volatility, crashes, expansions. That's how real quant traders validate strategies. Not by vibes, not by psychology, not by I felt confident in this trade, but by data. So let me show you exactly what I tested. This is a classic ICT Fair Value Gap strategy. Time frame, the one that ICT most often uses, 1 minute. Market, NQ futures. Entry is at the start of fair value gap. So for bullish fair value gap, like here, it will be on the top of fair value gap. Stop loss is at the nearest swing low. Target is 3 risk to reward, and it's allowed to take only 1 trade at a time. For shorts, logic is the same, just reversed. So here is the strategy. It made over 6,000 trades. This is a good sample, 25.7% win rate. So at 3R, you need at least 25% win rate to break even. So it has just a bit higher win rate than that. It got 0.4 Sharpe ratio. That's not too good. Normally, professional traders would want at least above 1 minimum, but extremely good strategies will have a Sharpe ratio of over 2. So, Calmer ratio, it got 1.6. Typically, you'll want Calmer ratio to be at least at around 3 or more. My best performing strategy has 8.6 Calmer ratio in last 10 years. This ICT Fair Value Gap strategy is not close to that. Profit factor is just a bit over 1. If it has profit factor at around 2, that is considered extremely good strategy. Maximum consecutive wins it got is 7. maximum consecutive losses is 22, so that's quite high. Now let's go to the profit and loss. This is all based on trading just one contract. This strategy is profitable. It made $157,000 in last decade while having maximum drawdown of 97,000. So this maximum drawdown is quite high for the amount of profit it got. ICT Fair Value Gap strategy is profitable, but let's compare it to just buy and hold, which means you just bought with one contract and hold it over time. Boom. So buy and hold strategy outperforms ICT's Fair Value Gap strategy in almost every possible metric. Maximum drawdown is a bit higher, $116,000, while Fair Value Gap strategy got $97,000. So here, Fair Value Gap strategy, you could say it outperforms buy and hold. But buy and hold have almost double the Sharpe ratio of FVG strategy. Its Calmer ratio is over 2 times better, it's 3.7. Profit factor is also better. In total profit is almost triple the profit of Fair Value Gap strategy while having just a bit higher drawdown. So comparing Fair Value Gap strategy, buy and hold is, in my opinion, superior strategy. And you don't need to do anything. You don't need to place 6,000 of trades, you don't need to manage them, you can go about with your life. Here I have equity curve for FVG, and as you can see here, in first couple of years it wasn't making or losing any money, dropped here a bit at 2019, made finally some gains at around 2020, and then lost everything again. So this is not what you want to see. In last 2 years it performed a bit better than before, but if we compare it to buy and hold strategy, so the buy and hold is here in gray line and FVG is in green, you would have made more money with less stress by simply buying and holding NQ futures. Trading gurus love to tell you lost because of psychology. You didn't believe enough. You hesitated. You broke your rules. But let me ask you something. If a strategy has no statistical edge, what kind of psychology will make it profitable? None. You can have monk level discipline, you'll still lose. Psychology only matters after you have a validated, profitable strategy. Data first, feeling second. Data first, feeling second. Losing for a short period is normal, but prolonged losing, that's not psychology. That's not bad luck. That's a strategy that was never validated. If you're bleeding slowly, month after month, you are trading something that does not work. And deep down, you already know it. If you're bleeding slowly, month after month, you're trading something that does not work. Most retail traders never fail because they are lazy. They fail because they skip the hardest, most important step, validation. They jump from strategy to strategy, confusing randomness for edge and blaming themselves when probability finally catches up. Here's the takeaway I want you to remember, and this applies whether you trade ICT, indicators, or pure discretion. If you're trading a strategy that you have not properly backtested, you're not trading, you're hoping. and hope doesn't pay the bills. Data is the difference. Data removes ego. Data removes excuses. When you have real data, you don't need motivation. You don't need affirmations. You don't need to trust the process. You already know the process works. And if the data says it doesn't, that's not failure. That's information saving you time, money, and emotional damage. Professional traders trade validated systems. Retail traders trade stories. Only one survives long term. Which one are you gonna be?